Okay, 12 o'clock. Well, good afternoon, everybody. Thank you so much for joining us today for our webinar series. Today, we have a really excellent webinar, Tips for Financing Your Not-for-Profit Projects and Expansion. My name is Allison Lafrelita. I am the Executive Director for the Nonprofit Resource Hub. For those of you that may not be familiar with us, we are a trade association that supports the work that you do through education like this webinar, different resources. We're a one-stop shop for you in terms of resources, uh, including those that provide support services and goods to the industry. Today we have two wonderful panelists on. We are panelists, guest speakers, excuse me. We have Sunil Aggarwal, founder and principal at ThinkForward Financial, and Andrea Kantor, Managing Director for Not-for-Profit Banking at Webster Bank. Today, they're going to take you through financing your NFP projects and expansion. You are welcome to put in the chat your name, your title, the organization that you're with, your LinkedIn handle if you would like, and any questions you may have. At the end of the presentation, Sunil and Andrea will be fielding those questions. If there's anything that seems dire, I may jump in, but I think we can make it through the first 30 minutes of them talking. So if you're not a nonprofit partner with us, please do join us at the nonprofitresourcehub.org. It is free to nonprofits to join. I have been an executive director for over 25 years. This is an amazing resource for you. I wish I had it 25 years ago. So please do take a moment and join. Uh, and if you have any questions for us after this, you are always welcome to reach out and somebody will be certain to get back in touch with you. So without further ado, let's open it up to our speakers. Andrea and Sunil, welcome.
Thank you, Allison, and thank you everyone for being here. And thank you to my partner today, Sunil.
Thank you. Nice meeting you.
We're so excited to be here. And to dive into today's topic, tips for financing not-for-profit projects and expansion. So the first thing I want to do is just read a legal disclaimer. The information contained in this presentation and today's discussion are intended as general information and is not to be construed as direct advice for any specific situation. It does not represent any official policy of Webster Bank and ThinkForward Financial. Neither Webster Bank nor ThinkForward Financial nor the presenters shall be liable for any damages due to errors or omissions. Okay. Without further ado, this is our agenda today. The focus of this presentation and the discussion are about financing capital projects and capacity building. And we're going to talk about assembling your team and what some of the financing alternatives are, et cetera. But really, that's the focus. Truth in advertising, that's what we're going to talk about today. This is just who we are. Lovely pictures. We've never looked better.
So I've been working with Andrea for 15 years. I'm financial advisor, and Andrea Kantor right now is with Webster Bank, heading the not-for-profit banking there. So, we work as a team. I'm the advisor and she's the lender.
Thanks. Okay, so to kick us off, let's just define kind of the universe of organizations that we're talking about. We're really talking about any mission-driven organization, 501c3s. We tried to capture everybody on the slide here. So hopefully your organization fits in one of these categories, or you'll tell us what we forgot to include, because really we're talking about the whole nonprofit community and the different types of projects, the different types of financing that you have access to finance those projects. So whether it's housing, social services, health services, religious institutions, community organizations, and feel free to put in the chat what kind of organization you represent today, whether you're a board member or a member of the staff or the executive team. Hopefully you fit somehow on this slide. Okay, great. This is one of my favorite slides for today because it really captures the why around capital projects. So what are we talking about? Why are we talking about capital projects, and what drives the need for an organization to make an investment that would be considered a capital project? So we're talking about growth and the need for more space. Usually that's what we're talking about. Like a capital project is a project that usually involves property and the expansion of some type of activity that the organization is doing. So on the left side, we're talking about programmatic needs, rising demand for services, enrollment growth in a school, for example, new programs that an organization wants to bring on board. New technology sometimes requires new space. Maybe an organization is consolidating operations from multiple locations into a single location to be more efficient. And then at the bottom on the left, I said administrative offices. So sometimes, just growth in the organization requires growth in more people, and then there aren't enough desks in the headquarters, and you make a decision to move to new digs. The cautionary tale around growth is some organizations think if they just make the space bigger, more people will show up. And that's sometimes a bad idea, because if they don't show up, then it might not result in the increase in revenue, the increase in cash flow to be able to afford the debt that was incurred for the project. And so then it's a waste. So the cautionary tale around growth is make sure you know that you need that growth, that you really have these reasons for needing to have larger space or more efficient space. On the right side of the slide, we talk more about what is a capital project. So the acquisition and improvement of property, expansion of an existing facility, new construction, renovation of space, leasehold improvements, which can be very common if an organization doesn't own the space, but you're maybe in a long-term lease for space and you want to reconfigure the inside, move walls and move things around, install new technology. And then, of course, systems upgrades. More and more systems need more and more space. You might need a special room for certain types of equipment, and that might take an investment of capital. So these are all the things that we're really talking about here: capital projects and capacity building. So the next topic is around assembling an initial team to think through a project. So let's say you're at a point where you need more space for some reason that we've talked about, but you need to assemble an initial group of people to have that conversation of what that would look like. What's the dream? What's the future state? And so this initial team often includes some of these different kinds of professionals on your team. So a real estate consultant or advisor can help you think through things like the purchase or lease decision, project costs, those kinds of things. They might even help you find actual space. Like further down on this list is real estate broker. So sometimes that person could be the real estate consultant, but other times a real estate broker can help you find the space you're looking for if you're looking for new space. A financial advisor to review financial feasibility of the project, of what you have in mind. For example, let's say you're looking to do a project that your advisors think would be maybe a $30 million project, but you're not going to be able to get there financially. You need to downsize the project or introduce phases so that, okay, we can afford phase one of this project. Let's kind of create a timeline that over time you can grow into being able to afford the project. So a financial advisor is very important in figuring out what's feasible. As a banker, of course, I always recommend talking to your existing bank about launching a project, because they probably, of all the financial people in the organization's life, they probably know the organization the best, especially if you're an existing client, an existing borrower. They probably know your financials the best of the outside world. So really having that initial conversation with your bank, thinking through if there are any limitations in your existing banking arrangements that could prevent you from doing certain things. So you want to kind of get ahead of that process if you're going to need any permissions from your existing bank, and also your existing bank can play a role or make suggestions about some of these other partners or some of the other things that you can look out for as you move forward in the project. Then we recommend talking to your counsel, talking to a legal advisor about things that relate to perhaps purchasing property or signing a new lease, or looking into the other partners that you might have to contract with. You might want somebody to review that contract and really get legal advice from someone who's an expert at what you're talking about doing for the organization. Some organizations have an attorney already that they've worked with, and other organizations I find don't really have a strong legal relationship. So it might be an opportunity to start a new relationship with an attorney to bring into this process. I talked about real estate broker, and then really importantly, a fundraising consultant, because fundraising consultants are experts at helping you figure out what your fundraising capability is. And fundraising often plays a key role in a project, because what you can raise can reduce the amount that you need to borrow, which ultimately is good for you, because you don't pay interest on what you've raised. That's money that you could put directly into the project. Whereas if you borrow money, you have an interest cost going forward. So I usually say the more money you can raise, the better. You can also raise money for an endowment and things like that. But today we're talking about capital projects. But fundraising consultant is really important in helping you assess your stakeholders, your community that's going to support this project. And then we would be remiss if we didn't talk about the role of your board. So in connection with other things, you might already be doing a board assessment and seeing what talents and experience and knowledge you have on your board, and thinking about, maybe filling some of those gaps with recruiting other new board members and additional board members. So it's really important to think about what's the expertise on your board. Some boards have a lot of real estate expertise. So when you're talking about a capital project, they can really help you and get involved in that. They may have financing expertise that they can bring to the table. And most importantly, your board needs to be involved in any fundraising initiatives.
Yeah, that's true.
So that's the initial team. Then things get more complicated. The initial team can help you start evaluating things, but this is when the rubber really hits the road, when you're ready to move forward and actually embark on the project. Then you're involving lots of different people. You're talking to lenders about term sheets for the terms of debt. You're talking to a placement agent who can help you through that process. If you're interviewing, we call it the RFP process, request for proposals, is when a financial advisor and placement agent can put something out to bid. That's often the language we use, where lenders will receive that RFP, including your existing lender or your existing bank and other lenders who that placement agent knows in the industry that work with nonprofits on capital projects. So you want to make sure you're working with experts in your field, so a placement agent can really help you find the right financial partner, the right lending partner. I can't emphasize enough how important each of these people at the table, each of these professionals and experts at the table will mean to you as you move through a project. Obviously, your architect, the engineers that you work with, the general contractor, and the arrangement you make with the general contractor to complete the project. Again, whether that's renovation or new construction ground up. An owner's rep can really help you with project management, energy and technology consultants. And I know Sunil is going to talk later about there are different ways to finance energy projects. So if there's something energy efficient about your project, you're going to want an expert at the table helping you work through that. Obviously, your CPA, your auditor, your auditing, your accounting partner is really important in this process. Insurance becomes extremely important, especially when working on a new project. A title company, which probably your lawyer will find for you. We put tax-exempt bond financing in a box here because that's a whole other seminar. We could talk for hours about tax-exempt bond financing. Right. So that's a different seminar, but it's one of the types of financing, and that introduces other professionals at the table that you would be partnering with: an issuing authority, bond counsel, a bond trustee. It's just a higher degree of difficulty, but for the right situation makes a lot of sense. But we put it off to the side in a box. It brings more people on board. It's a little more complicated to get the deal done. And there are reasons that we do those kinds of transactions for the right situation. let's see where, okay. Debt capacity. How much debt can you afford? So as I said before, what if you have a $30 million dream, but you really couldn't afford more than a few $1,000,000? What do you do about that? And how do you figure out what your debt capacity is? So as a lender in my career, I've had deal opportunities come up where someone's looking for a mortgage against a building where the building would be the collateral, and the appraisal for the building, I'll stick to my $30 million number. They'll say, but the building's worth 30 million. So surely you'd be willing to lend us, 20 million or 25 million against that building, right? Well, the answer is it depends, because collateral's nice. That's a nice structural element. But at the end of the day, lenders don't get repaid by that piece of collateral. Lenders get repaid with cash flow and other sources of money that you have as an organization. So collateral is really nice, and it's very important. And as a regulated institution, banks have certain requirements around mortgage collateral. So that it is an important topic, but it's not usually the repayment source, particularly if you're talking about a not-for-profit. Imagine a group home that has maybe 6 adults living with a house manager and a team of staff members that help with activities of daily living and entertainment and other activities of the house. Sure, that house could be collateral, but it's not a repayment source. Liquidating that collateral, taking possession of that collateral, that's not a repayment source. The people live there. So enough said about collateral. I think you get my drift. It's important, but it's not the repayment source. So what is the repayment source? For most organizations, it's operating cash flow. It's, if you think about what cash flow is, I won't do an accounting lesson today, but it's revenue less expenses. How much money are you taking in? How much money are you spending? What's left over? And, what's left over that's cash that you can use for debt service. And debt service, when I say debt service, what I mean is interest on the debt, as well as amortization of principal. And amortization just means spreading the principal payments out over the life of the debt, over the life of the loan. So, so that's like a little high-level version of what operating cash flow is. Lenders also look at revenue sources. Some organizations do one thing, and all their revenue, all the money they take in, is generated by that one activity. But you also have other revenue sources. Sometimes in most cases, there's multiple programs that are generating revenue. Some are more profitable than others. So looking at the operations and the diversification of operations. Another source of revenue is contributions and donations and grants. So that's another thing that a lender would be looking at, is what's kind of the sustainable number there in terms of an annual fund? How much is the organization taking in on an annual basis from an annual campaign or other sources of donations? Are there regular grants coming in? What are the specifics of your organization? And what's the schedule for collection of pledges? If you've had a capital campaign or you're going to embark on a capital campaign, a lot of times large pledges are collected over a period of years. So understanding what the schedule of the pledge collection is very important to a lender. If that's a repayment source for the loan, you want to make sure that the organization will have that cash on hand, not just the IOU from the donor. And then when we say balance sheet liquidity, what we mean is an organization's cash on hand and investments. So some organizations are lucky enough to have actual money in the bank or money in an investment account. That can be a source of liquidity that can repay debt if operating cash flow isn't sufficient. And then it's really important to keep in mind existing debt. If the organization has existing debt, is that going to be refinanced with as part of a new incurrence of debt for a capital project? Will it be rolled in, or will that remain in place as other debt from the new debt for the capital project? And then in some cases, sale of assets could be a repayment source. For example, if your organization is moving to a new headquarters building, maybe the plan is that when you move into the new building, you're going to sell the old one. So maybe the sale of that asset could be a repayment source. and it could pay down a big chunk of the debt that you incur for the new project. So these are just some of the examples of what a lender is thinking about when we think about debt capacity, is how much can you afford to borrow. The source of repayment is really important. There are also some intangible things, or things that are kind of a look back, like how did the organization do during COVID? What was the contingency plan? What happened to revenue and expenses during COVID and since? Was the organization reliant on COVID relief from the government? And what has happened since that relief has ended? Economic trends are really important. So how well positioned is the organization to handle rising interest rates, which we've all lived through personally and professionally over the last couple of years, or actually really over the last year and change. These very steep rise in interest rates, how has that impacted the organization's operating cash flow, for example? So these are some of the things to look at. And I would be remiss if I don't want to move on from this slide without also mentioning, what's the purpose of the debt? What is the feasibility of the project itself? How likely is the project to generate additional revenue for the organization? Or is the new project really an expense and isn't likely to generate new revenue? I can give you a really good example of that. I'm going to use an example of a private school for that. So a private school has X number of students, and they decide they're going to upgrade their science facility so that they can, keep pace with their competitors. They want to upgrade their science lab and introduce a maker studio and all kinds of really wonderful science things. So they may not be counting on increasing enrollment. That investment in that science lab is an enhancement to the existing program that isn't likely to increase revenue, but it's an investment they want to make to keep pace with the industry, with what parents and families want for their children. So that's an example of a project that may not throw off any additional revenue, but it's important to the sustainability of the program overall. So that's an example of a project that's not going to generate additional revenue. If they were adding classrooms, on the other hand, and increasing their capacity, and they could increase enrollment, then one of the things we would be looking at is, well, how big is your waiting list? How many applications do you get to get some comfort that they can actually fill the new seats? If they're adding 50 seats, let's say 3 classrooms, can they fill those seats? How long will it take them to grow the enrollment? That's an example of a project. If they're adding classrooms, that's an example of a project that is expected to generate additional revenue for the organization. I think I've exhausted this slide.
Yeah.
I love this topic. I could talk about it for a long time. Oh, Sunil, I think this is you.
Yeah, that's it. Andrea, you have spoken a lot. So, yeah, the main thing is about the financing sources, financing options. You know that you are doing the project, you decided to pursue expansion project, a capital project, but there are many, many options available to a not-for-profit 501c3. And you should be exploring all those options. Andrea and I was talking yesterday that we don't like not-for-profits to take on a lot of debt, additional debt, that try to explore other options, see if there are grants available, there's low-cost other financing available. We have seen many times, especially with private schools, small elementary K-8 schools. They build their facilities in the anticipation they will have the enrollment. They purchased large projects, large facilities, and borrowed. Before COVID, they borrowed a lot of money, and now they're in trouble because too much debt and not much of enrollment. And similarly with other social service agencies. So in any case, there are many, many programs available. We'll touch base on some of them, from the debt financing, tax-exempt financing, from community lending to grants. And we have utilized many of these programs with our not-for-profit real estate projects. There's always a combination of many of these programs to make that happen. Even though you might have the debt capacity, but that doesn't mean you need to utilize all that debt capacity to do the project. For example, as a 501c3, we'll talk about a tax-exempt bond financing. Many 501c3 utilize this option, which has been there since 1986. As a 501c3 not-for-profit organization, you can borrow in the tax-exempt bond market to finance your capital projects. Now, the main advantage of tax-exempt bond is a lower interest rate financing versus conventional loans. Like for today's market, if you're talking about mortgages of 7%, the bond financing could be raised at 5%. So you can save that 2% for the 30 years, next 30 years. And there are different structures in the tax-exempt bond market. For example, bank like Webster Bank, Andrea's bank can purchase those bonds and give you a tax-exempt bond or tax-exempt loan at those 5% rates I'm talking about. But there are pluses and minuses. For example, banks require higher equity in the project. It used to be 20% equity, 15% equity, but Andrea can speak to it. Now the banks are very conservative, and for even good credits, they're looking at 25% equity, sometimes as high as 30%. And sometimes that's not available with a not-for-profit. Yes, you can take advantage of the lower rates, but you don't have the cash to put into the project. So there are two ways to do tax-exempt bond financing. One is to sell to a bank, and they buy the tax-exempt bond and put it into their portfolio, just like a mortgage, except the rates are lower on tax-exempt bonds because the bank, they don't pay any interest income or taxes on the interest income they generate from the loan. The other method is you can sell the bonds in the public markets, in the capital markets. You hire a placement agent or an underwriter. Generally, that's accessed by rated institutions or large institutions with the borrowing more than $10-20 million. We are talking about projects from $10 million to $100 million range, which is accessed by private, highly credited private schools, universities, hospitals. But that's available in tax-exempt bond market. Another option is loans from community development financial institutions. And there's a lot of money being channeled through CDFIs. There are 1,000 CDFIs in the country, in the nation. For example, in New York, we have LISC, LIF, Low Income Fund, Not-for-Profit Fund, Blue Hub in Massachusetts. So there are many CDFIs. They are focusing on projects in low-income areas. For example, projects which have social impact. They look at the community impact of the project, but also they have limitations. They have limited funds. They can go up to $10 million range, but more on flexible terms than bond financing or any other type of financings. And they can provide pre-development loans. They can do bridge loans, construction loans. They don't provide long-term financing like banks and capital markets. Maximum they can lend is for 70 years. But you should be talking to community development financial institution if you have small projects. Sometimes you just need a couple of $1 million to make renovations, and they can take a second mortgage. Unlike a bank, they can take a second mortgage on the project, or they can take other collateral, like you might have a city capital funding, or you have a public contracts or a long-term contracts. They can take them as a collateral as well. My other thing is recently, over the last couple of years, the city capital funding. I have worked on many projects recently where we have been able to get city capital funding from the borough president's office, from city council, from the speaker. One project we recently worked was like $8.5 million acquisition. They got $5 million from the city as a grant. They got a $1.5 million from the state. So technically, there was no debt. It was all funded through grants. But of course, it comes with many restrictions. One of the restrictions is that the project has to be utilized for its purpose. So there's going to be covenant on the property that is going to be used for whatever the purpose is of the facility. And to be eligible, you got to be non-for-profit, you got to be 501c3, you must have an existing operating contracts with the city. But it's a grant. It's given as on a reimbursement basis. You can utilize for acquisition or renovations or new construction, but it's provided on a reimbursement basis. That means that you have to bridge the capital grant. It takes about anywhere from 18 months to 24 months before the city releases the money through a funding agreement with their Office of Management and Budget. But this is a grant. You should be looking at this. Taxable loans, bank loans. These days, banks are of course active, but there are other non-bank lenders can provide you a mortgage. And we had talked about the banking landscape, how that has changed. If pre-COVID to now, especially when the rates have doubled in the last 2 or 3 years, banks are a little bit reluctant. And what's going on in the maybe Andrea will talk more about that in the presentation. Now, there are other grants and other tax credits available from different programs. One of them utilized by not-for-profit is a new market tax credits. If you can get the allocations of these tax credits, you can generate about anywhere up to 20% of equity for the project. But it's on a very selective basis. The eligibility is very stringent, and it complicates other capital stacks, other structure, issues with the financing. But it's available. It's utilized by projects located in a severely distressed areas. For example, health centers or schools or other community facilities. If you're arts and cultural institutions, you should be looking at grants from the state, grants from DCL in the city, or New York State Council of Arts. And we have good examples of that, where our clients has been successful in obtaining those grants when the project was not feasible, and those grants were very helpful. Andrea mentioned about energy upgrades, which is a hot topic these days. Many not-for-profits or even commercial in industrial sector, they have to comply with the local laws, and they have to improve their facilities. Or in any case, they have to improve their facilities, especially on the energy side. And then a lot of money is being channeled to finance energy. And one of the program is called CPACE, Commercial Property Assessment Clean Energy Program. Basically, it's a lending. It's a private lending through not-for-profit, but the payment is made under this program through a special assessment on the building. So basically, this is going to be a special assessment on the building, which will pay the loan, but you get 100% of the monies required to do those upgrades. So there are a lot of resources available to 501c3s. For example, charter schools have additional resources. There are private lenders or foundations like Walton Foundation, for example, which can lend it to charter schools who are young charter schools without renewal of the charter. And now the question is, what type of loans we are talking about? It could be development loans to fund your cost before you actually acquire the property. There could be acquisition loans, construction loans, or construction and permanent loan in one package, long-term mortgages, bridge loans to capital campaign or government grants, or any other public contracts you might have. Sometimes there's a refinancing opportunity if you have an existing debt that may be refinanced through tax-exempt bond or maybe at a reduced rate. Not in this market. It used to be a lot during before COVID. And Andrea has seen many, I think, Andrea, you have seen many organizations approaching you to borrow against their endowment assets, rather than incurring high cost commercial debt. they want to take advantage of low rates and borrow against their endowment assets.
Yeah, it's most clients that use that type of financing against their endowment assets, it's a pretty cheap source. But it's not meant to be permanent. You know, it's a good bridge to something else, to a different kind of loan, but it's very low cost. It's a margin loan against, you know, investments. So that tends to be, it's much cheaper. Banks, you know, a bank lender can't compete with that pricing, but it's really meant more of as a bridge to a permanent takeout.
Right. So you can see there are many programs, and you should hire advisors or consultants or really explore all these options. You should be talking to your banker to see if they can put you in touch with some of these options. But to me, you don't necessarily have to borrow, you incur debt. There are many other resources which you can combine with debt financing. Here are some of the examples we have worked on recently, and Andrea has worked on a few of them. And you can see we have utilized all kinds of programs, from city funding to tax-exempt bonds, to bank loans, term loans, to selling an existing building, selling an existing asset, and financing a portion of the project. So our advice is explore all your options. So that's the end of our presentation, and we'll be happy to answer any questions.
Sunil, while people are waiting or figuring out what their questions are and maybe putting them in the chat or speaking up, is there anything that you thought of along the way during our presentation that you wish we had talked about, or anything that occurs to you that you want to share?
No, my experience has been that things change. You know, pre-COVID, everybody was borrowing money, doing large projects, and of course, nobody anticipated COVID, but now inflation, there's inflation, the interest rates doubled. So we have seen many organizations struggling today. I know there were a lot of government programs during COVID that helped, but to me, take advantage of these all other alternative options. And the governments, foundations, private foundations are providing a lot of resources for these projects, and you should be exploring those options. So to me, again, I will say, you know, of course, we want to sell debt. We want to advise that you borrow money, but I'll say you should take advantage of the other alternative programs.
Yeah.
Thank you. We have questions. I don't know if you want to answer them. I've been watching the chat.
Thanks, Allison. You want to?
Sure.
Yeah.
Sure. We have a Colette Tabor. She's a business writer, and she wants to know, what are the current rates on the financing options discussed today?
For example, tax-exempt bond financing, and we talked about two options. One is selling the bonds to banks like Webster Bank, and Andrea can talk about those rates. But as I said before, the difference between mortgage and bank tax-exempt rate is 2%. But in any case, I will say the average rates are about 5% with banks, whereas that could be 7.5% in capital markets. CDFIs, the rates may be a little bit higher than the bank rates. These days, the rates are anywhere from 7.5% to 8.5% range. And that's for short-term financing, not long-term financing. The financing is anywhere from 3 to 7 years. So it depends. Tax-exempt rates could be as low as 5%. The mortgage rates, CDFI rates, and bridge loan rates, they could be as high as 7 to 8%. So maybe Andrea,
Yeah, I can speak to that as well. I agree with everything you said, Sunil. What I've experienced is that lending spreads have not changed significantly since before COVID and since with the inflation that we've been living with, but the market rates have gone up. So when we, you know, banks, the spread is the money that we make on the loan over and above the cost. So the base rates have all more than doubled, as you pointed out. So even if our spread stays the same, that rising rate environment has been crazy. The amount that people are paying for money is really, at a high, certainly for the last 10 years or so. But I would say, to answer that kind of question, what are the rates? I usually say it depends, because it depends what the loan is for. So for example, construction loans are riskier than a term loan, because during the construction phase, the risk to everybody involved is that the project doesn't get finished anywhere near the budgeted amount, and that there are too many cost overruns or interruptions, or that the project never gets finished, which doesn't happen a lot, but it does happen sometimes. And so, everyone at the table is taking more risk during the construction phase. So construction loans tend to be more expensive than the term out. So that's often why, and you referred to it, Sunil, you see a structure of a loan that's called construction to perm. Right. So what that means is maybe for 18 months or 2 years, whatever the estimated construction timeline is, during that period of time, there's probably going to be a higher interest rate on the loan. And then at the end of the project, it'll convert to a term loan. And you can do that taxable or tax exempt, so that's not an issue. But then it converts to a normal term loan, and that pricing will probably get determined at the point of conversion, and it'll be set in advance as, a spread over whatever some market rate is at that point in time, because the bank is taking less risk in the sense that there's no more construction risk anymore. The project is over. So that's one of the differences you'll see in pricing. The other thing I'll just say about the bank market is, while there's still competition among lenders for different deals, a couple of thoughts on that. Not every bank is the right, or not every lender is the right lender for every situation. I've never thought that I'm the right choice for everybody. It's like anything, you have to find the right partner for you, and not everybody's the right partner. So one is, there's still competition. It's a little softer because banks are focused on other things right now because of the inflationary environment and the crisis in the banking market last year, about a year ago from now. So, we're definitely seeing more of a focus on full banking relationships, which has always been a requirement, but it's very strict right now. If you're looking for a new lender or looking for your first lender, the lender is, if the lender is a bank, they will require all of your banking business, your operating accounts, your payroll accounts, the day-to-day banking that you do, and wherever you keep your liquidity, other than probably an investment account. A bank is not necessarily an investment advisor. Not every bank has that capability, but banks are being much more strict about requiring the total relationship, looking at how much equity the organization is going to put into the project, to determine things like the rate. So the answer to the rate is, it depends, but that's from the banking perspective. The only other thing I wanted to add is that, we didn't talk about working capital lines of credit today at all, because our focus has been on capital projects, but that's a real challenge for organizations, and something that you should be talking to your banks and other stakeholders about, because again, lines of credit are costing more than double what they cost a year ago or 18 months ago. So definitely a hot topic, something we can talk about at another time. And the only other thing that, then I'm really going to stop, is that nothing we've said today is a commentary on the impact, the social impact, the impact on your stakeholders of your programs. This was a conversation about financing options for growth, but creditworthiness isn't the same thing as social impact or impact, mission impact. So, I didn't want anyone to think that, if your credit profile isn't strong, that it says anything about the work that you do in the community. We need nonprofits to serve the community, and we need to do everything we can to support and find the resources to support the mission and the growth of your ability to meet that mission. And that's why some of the programs Sunil talked about are so important, because some of those are grant programs. A bank or another lender might be able to bridge the grant for you, for example, if you have to lay out the money and get reimbursed later. But those programs are so important. Borrowing isn't the only way to fund growth. It's just one of the ways. And those programs, Sunil, that you talked about earlier, I'm not even familiar with some of them because they don't all involve banks. So you're my first call when someone says, do you know anything about this program? No, but I know someone who does. So, lending is not the be all and end all. It's an important part of the picture. But Sunil, I really appreciate the picture that you presented, that there are other options than borrowing to finance capital projects.
There are many options these days. Now you have an online option as well. We just raised like $1 million for a small not-for-profit where it was not bankable. Nobody was really lending us the money. But we have a strong support system, and we have some donors supporting us. And so we use the online platform. One of the platforms is called Lend Donate. So, if you need money from $500,000 to $2 million range, that's an excellent platform, and we have used it a couple of times. So that's also popping up these days. Online system, options. And also we work with foundations. Sometimes foundations, they manage donor advised funds, and they are willing to make loans on a flexible terms with no fees. We have done, we have utilized those programs as well. So I agree with
There's
you.
a lot of options, it sounds like.
There's a lot there, yes.
So what I want to, it's funny because I've been going through the list to see who's on with us today, and we really have a wide range of organizations and people in different capacities at each organization. And just being that I do this every day, I think a good question to ask is, first, Sunil, if you don't mind sharing the links to any of those resources that you shared in the chat, that would be very helpful, like the one you just mentioned.
Definitely.
Also, I think knowing what we've heard, excuse me, in the past is this can be an incredibly overwhelming experience for a nonprofit. And sometimes there's, one person running it, sometimes there's 250 people, and we do have a range here with us today. What would your recommendation be for those nonprofits that are really just starting to dip their toe into this, and how they can be, this is obviously the first step in educating, but who should they be connecting with to learn more? Where can they find their resources? And where is it best for them, in your opinion, to really start the process with these projects that they want to go with?
I always say you should have at least two advisors on the table. If it's a real estate, you got to be talking to real estate advisor. They specialize in not-for-profits, and from all kinds of different not-for-profits, from arts and culture to social service, and then if it's financing, you should be engaging an advisor because, as I said, there's so many options there, from small loans to large. Yes, you should be talking to your banker as well, but to me, it's maze out there in terms of the options. You may be missing, and I've seen many times, you might take on a debt and finance your project with the debt, but you could have received, or you could have obtained city capital funding, or NICA funding, or DCLA funding, or for health centers like HRSA, grants. So to me, and now federal government is putting so much money into energy and housing and low-income areas. So to me, and there's no one advisor who's kind of keep track of everything, but you should be talking, in my opinion, you should be talking to some advisor who knows all these things, and also your real estate advisor about real estate assets. Sometimes you don't need to just expand your facilities to see what you have. And many times I see not-for-profits are trying to maximize or monetize their existing assets. Maybe they're consolidating different facilities, especially in this environment, or they're taking advantage of new zoning laws and working with developers and development partners to monetize those assets rather than just keep borrowing money. But in any case, to me, real estate consultants, advisors, financial advisors, and your existing bankers, that's where you should start your conversation with.
And there are people on the phone today who know I'll have a conversation with anyone about this topic. So anyone in your circle or people that you reach out to who are out here in the public trying to spread the word and share resources, anyone should be willing to have a conversation with you to help you get on track and meet the right people.
Thank you. And in terms, let's say we have the larger, more established organizations with us. Do you have any wisdom that you'd want to share with them in terms of if they're looking to expand, if they're looking to build on their programming that they already have, but they need the capital for it?
Yes, as again, we can share all these resources and information. But what I've seen in terms of established organizations, first thing they look to is the tax-exempt bond financing, because the rates are lower. They want to take advantage of the triple tax exemption, and that's available. But that's available for more established organizations.
Right. I think, Andrea, you brought up a really good point, and I'm so glad you said it because it can be scary when I'm sure, I think it was you actually that said, don't worry so much about your credit. If you're newer and you're trying to gain your legs, there's other ways for you to go about doing that, because I think that can stop a lot of organizations from wanting to pursue the growth because they are intimidated by that. So thank you so much for saying that. That's really, really important. I appreciate that. We also have another one here that says, Sunil, I'd appreciate hearing more about city capital grants, specifically how to access and when to start the process. Isn't that just a call to you?
That's a call to me because you cannot cover over the presentation, but there's a time frames, there's a process, there is a applications, of course. There's eligibility. First we need to determine if you could be eligible. As I said before, you must have an existing operating contracts with them, and this is something they would like to entertain. So yes, it is a call or email to me, and it's there's a process every. It starts once a year, but you got to talk to your lobbyists. You have to have relationships with your city council members. And as I said before, it takes anywhere from 18 to 24 months before you can, obtain these grants. So, but yes, I can give you more information, and if the person reaches out to us.
Thank you. We don't have any more questions right now. Andrea, did you want to add anything? Do you have any feedback?
Allison, I don't know if we've had a session on this topic, but it strikes me to mention it that, boards and executive leaders of organizations will meet sometimes for a strategic planning process, and they'll come up with the 5-year plan or the 10-year plan. And capital projects can be part of that plan. Fundraising is part of that plan. Financing is part of that plan. Where is our organization? Where are we going? What do we want to get better at? What do we want to do to meet the needs of our stakeholders, our community, our mission? And I feel like some of what we've talked about today, it's not like everyone's going to go out tomorrow and raise $10 million or finance a $5 million project. It's not all going to happen tomorrow. It's the outlook. And that's really what boards and management should be working on together, is what's the outlook for the organization? What are the pieces we need to be thinking about? What's our aspiration? Where are we needed? And who do we need at the table? That's hopefully what people came away from today with. We have these ideas, but who do we need at the table to get us thinking clearly, have a plan? What can we grow into? Maybe we aspire to grow by leaps and bounds, but how do we get there? What's the plan? What are the nuts and bolts? And who do we need to be in that conversation? And so hopefully we gave some people some good tips, because otherwise you waste a lot of time going in circles with yourself.
I
So
think you
it's like,
did.
who do we need to help us actually move forward and execute?
Yeah, and I think what my takeaway was, you need to start with an initial plan, then form your team, and then do your secondary plan,
Right.
to really do this in a cohesive manner. And you have to have the right people on that team. So another question, because somebody may want to know is, let's say they don't have a direct contact with a trusted, let's say, real estate advisor. Is there a space where they might be able to find one, aside from, of course, the Nonprofit Resource
I
Hub?
was
But
just going to say the Nonprofit Resource
you
Hub can
know,
help you.
we are the number one resource. But if they're, if they want to have, let's say, the hub doesn't have somebody outside of the New York area that they're looking for, is there a space that they can find outside of the hub, a resource?
I don't know if there's any official place other than call us, ask your CPA, ask your attorney, ask people that are already in your circle. Do you know someone who's in the real estate arena who specializes in working with nonprofits? They're out there. Not every firm has them.
Mhm.
The same way not every bank has a not-for-profit team, so put the word out that you're looking for that resource, but of course we can all be resources.
And it is so specific. It's something I always say, your nonprofit business is a unique business. So you really need to work with people that understand your unique business. And you have great resources that you know about because you are so immersed in it. So that's where I would go. Well, I want to thank you both so much for your time today, and for all of this that you shared. This will be available via recording for anybody that was not able to make it or would like to hear it again. I would say probably early next week. For those of you that would like to get in touch with Andrea and Sunil, we will be happy to provide you with their contact information. You may have put it in the chat. If you didn't, we'll be happy to provide that with the group. If you have any questions that you think of after this and you want to reach out to them, please let us know. We'll make sure we get you connected with them. And if you think of something that came from this presentation that you'd like to hear a more concentrated presentation on, let us know and we will try to set that up for you. So once again, I thank you both very much. For those of you that are not with the hub, please do join. It's free of charge, like I said, and this is one of many really informative webinars that you will have access to. Andrea, Sunil, I'll leave it for you to close if you have any closing remarks.
No, thank you. Thank you for the opportunity to talk to everyone. Again, here's our contact information or email addresses. You can write to us as well directly if you need to. But thank you again. I know it's a complicated world of managing not-for-profits and financing, but there are a lot of advisors and people there to help you.
Especially these two people and the
Thank you
hub.
for the opportunity. Thank you, Allison.
Thank you so much, guys. Have a wonderful weekend, everybody. And remember, your recording will be available early next week.
Thank you. Bye-bye.
Thank you. Have a great day.